Now the next heading you can give us, we will start with direct taxes. We will discuss all the different type of direct taxes. So the direct taxes. First one you can write the personal income tax. Personal income tax. So personal income tax. Actually, in your economy module, I have updated all these classes. This thing I have updated. So personal income tax, just before I have told you, right? So the tax slab also I have told you 0 to 2.5, no tax, 2.5 to 5 percentage, and 5 to 10, you have 5 to 7.5, you have 10 percentage, and then 7.5 to 10 you have 15 percentage. So that is actually the tax slab. So upon this rebate will be there, okay, up to 3 lakh actually 2,500 rebate is there, like that. And surcharge, I don't know exactly what is it. Before it was 50 lakh to 1 crore. 50 lakh to 1 crore there was a surcharge of 10 percentage extra above the tax. And if it is 1 crore above, more than 1 crore, there was a surcharge of 15 percentage. Correct. Currently, what exactly is the value? I'm not sure. But nobody will ask you what is that value of surcharge, etc. But you just need to know it is charged over and above the tax. So if your income, see here you can see the surcharges on the super rich people. Okay. Then second one, wealth tax. Wealth tax. It is no more there. It is actually abolished. And see, wealth tax is not imposed on home or property. Most of the people, most of the students understand in that way it is imposed on home or property. Okay, so it is actually imposed on non-financial wealth except this. Okay, except home or property. Just write over there, imposed on non-financial wealth except gold or property. Means it is actually imposed on gold, okay, cash, etc. Okay, now why it is abolished? Because it is very difficult to know how much gold or cash people are having. People will not disclose it. Okay, and the revenue collected under this wealth tax is actually very, very less. In fact, the investment to collect tax will be much more than the tax collected by itself. Okay, so and the main reason is the financial wealth is actually exempted. The land, buildings, all those were actually exempted, and that will be by the state. That, if you remember, when we discussed about fiscal federalism, I have discussed about that point, who will collect and how will collect, under which provision of constitution we have discussed. So here what will come under wealth tax? Gold, cash, etc., and it won't be disclosed by the people. So it is just for namesake this was there, so it got abolished. Okay, and instead of this only actually surcharge. Okay, so surcharge is on super rich people. So what is the assumption here? It is a kind of assumption, no? So they have too much of income, right? This surcharge is upon people who have more than 50 lakh. 50 lakh to 1 crore, we have discussed about 10%, and more than 1 crore, 15%. So what is the assumption here? They have more gold, they have cash, etc. So that is the assumption. So it's a kind of presumptive tax. So can I say surcharge is a presumptive tax? Yes. What is the assumption? These are people who they may have this gold, cash, etc. You can just write one line, presumptive tax. What do you mean by presumptive tax? Just because I use that word, I'm just explaining here. Presumptive tax. These taxes are imposed on the basis of assumption. These taxes are imposed on the basis of an assumption of the government that a person or firm is not paying adequate taxes as per his paying capacity. Okay. So the surcharge is actually an example of presumptive tax. So when I said that that 15 percentage, that 15 percentage will not be added with the existing 30 percentage. It's not that you need to pay entire 45 percentage. Okay, so this 15 percentage will be charged upon the tax. Okay, so it will be charged upon the tax only, not it become completely 45 percentage. It is not that 15 percentage plus the existing 30 percentage. No, 15 percentage of the 30 percentage above the tax. So another example of presumptive tax are MAT, minimum alternate tax. Just I'm going to discuss this MAT, AMT, alternate minimum tax, surcharge, etc. All these are examples of presumptive tax. I will discuss these two now, just now. Third one, you write corporate income tax. Okay, so it will be the tax which is imposed on the firms. Domestic companies 30 percentage, and foreign companies 40 percentage. Okay, so for example, domestic companies profit 1 to 10 crore and more than 10 crore. We'll talk about the surcharge here. So domestic companies, what is the tax? 30. Okay, and foreign companies, the tax, corporate income tax, that is 40. Now the surcharge will go like this. This is 5 percentage in case of domestic company, and foreign company 2 percentage. Here 10 percentage if it is above 10 crore, and then 5 percentage. Okay, so when I say this 5 percentage, this 5 percentage of what? 30. Okay, so what is 5 percentage of 30? That is 1.5. So effectively, if your income or the profit is 1 to 10 crore, you need to pay 31.5 percentage, not that 30 percentage plus 5 percentage. Okay, similarly, what is 2 percentage of 40? That is 0.8. So how much it will come here? 40.8 percentage, not 40 plus 2. Similarly, here also 30 plus 10 percentage of 30. What is that? Here it will become 33 percentage, and then 5 percentage of 40, that will be 42 percentage, including the surcharge. Okay. Now the fourth one, MAT, minimum alternate tax. Minimum alternate tax. So it was introduced in 1996. Firstly, you write it is introduced in 1996. It is imposed on firms. Just write one line. It is imposed on firms whose taxable income is less than certain percentage of their book profit. It is imposed on those firms whose taxable income is less than certain percentage of their book profit. Such firms have to pay MAT, minimum alternate tax, at 18.5 percentage of book profit. I'll explain this. Okay, so what I'm saying is it is imposed on those firms whose taxable income is less than certain percentage of their book profit. So your book profit is high, but when it comes to the taxable income, it is very low than a particular percentage. In those cases, you have to pay MAT. For example, what you earned is what your book profit. Okay, so for example, book profit is 10 lakh, and you will show the deduction 9 lakh. Okay, that means what is the taxable income here? Taxable income is, let's say, 1 lakh, and you will say this deduction is because of reinvestment, research and development, depreciation of machines, etc. Different deductions you can claim, no? So unnecessarily you will claim the deduction and you will reduce the taxable income. So that is why if it is going beyond a limit, Now the government will say, okay, you don't want to pay tax for 1 lakh. Okay, what you need to do, upon the book profit, pay flat 18.5 percentage. Okay, so I hope that point is very clear. Here, if you see, otherwise, how much you need to pay? You need to pay 30 percentage, right? So here, what the government is saying is, if you're showing this much deduction and 1 lakh, now what is 30 percentage here? As per this, you need to pay 30,000. The company is going to pay 30,000. But what the government will say, it is so much deduction, so it is beyond a certain percentage. So upon the book profit, you don't want to pay 30 percentage now. Don't pay this, pay just 18.5, but pay that on the book profit. That will be around 1.85 lakhs. Okay, now what is the assumption here? If you remember, in the presumptive tax, I have discussed this. I've told you there is an assumption here. What is the assumption made by the government? Because this deduction might be done purposely for the tax deduction, tax avoidance. Okay, so in that context, you need to pay. So whichever is higher, that is what you need to see here. Okay, so just write one more line. The firms have to pay corporate income tax or MAT, whichever is higher. So that means in simple language, you can understand government think what? Beyond 18.5 percentage, if you are making a reduction, that means you are misusing the provision of deduction. So up to 18.5 percentage is okay. Beyond that, it's a kind of misuse. That is a presumption here. Now, next is alternate minimum tax. Alternate minimum tax. Introduced in 2012. It is imposed on non-corporates. Imposed on non-corporates. Okay, non-corporate means I'm talking about partnerships, proprietorships, etc. Having profit over 20 lakhs. Just right. It is imposed on non-corporates having profit over 20 lakhs. It is imposed on non-corporates, for example, partnerships, proprietorships, etc., having profit over 20 lakhs. Okay, and this AMT is also imposed at 18.5 percentage of book profit. So now the reason is here, you see more than 20 lakh profit is there. Okay, but it won't come under corporate income tax because these are non-corporates. So you have to pay 18.5 percentage of book profit under AMT if the profit is more than 20 lakh. Next one, gift tax. Now it is imposed on the person who's receiving the gift. So you can write imposed on recipient. Okay. So basically gift is assumed as an income of recipient. So you have to pay income tax anyway. So that's why you need to pay gift tax. And what is the exemption limit in the context of gift tax? Exemption limit is 50,000. So actually what I'm saying is it is assumed as an income. So you need to pay income tax. So you have to pay gift tax. In case of income tax, there was an exemption of 2.5 lakh. In case of gift tax, there is an exemption of 50,000. If you get up to 50,000, you don't want to pay anything. But if you get 51,000, then entire 51,000 will be taxed. Unlike income. In case of income, if it is 2.5 lakh exemption, then 3 lakh is there means first 2.5 lakh you don't want to pay. But in case of gift tax, if it is up to 50,000, no. But 51,000, entire 51,000, not that rest of the 1,000. Okay. Now there are some other exceptions like gift from spouse, gift from blood relatives, etc. This will not come under taxation. All these are actually exempted. Close relatives, blood relatives, dowry, exempted. Okay. So spouse, blood relatives, close relatives, etc. Dowry, this is exempted. No tax for this. Okay. Is dowry is illegal? Any idea?
No.
Dowry is not illegal. In fact, we should give dowry. No, it is good because you are giving your daughter and you can give her property or whatever it is. It is good only. But what is illegal? Demanding dowry is what illegal. Okay. So here dowry is exempted. So don't think that dowry is illegal and all those things. It is there. It is like whatever you are giving to your girl child, it is fine. Okay. So there is no problem with that. But demanding dowry is illegal. So that is different context only. 7. Dividend distribution tax, DDT. Dividend distribution tax. So many times we have discussed about dividend. For example, the corporate income tax. If you see the profit of a company, let's say 10 lakh, and out of which you need to pay corporate income tax. I've told you 30%. So you will pay 3 lakh as corporate income tax. Then let's say 5 lakh. Okay, and let's say 3 lakh you reinvest. So this is what you call as undistributed profit, right? Because you are reinvesting. It is a profit. It is a profit, but not distributing to shareholder. It is reinvested. What about this 5 lakh? It will be distributed. It will be distributed to whom? The shareholders. So when you're distributing, this is what you call as what? Dividend. Okay. So while distributing dividend, there is a tax. So 15% of this will go as dividend distribution tax.
So wasn't this abolished? Wasn't this abolished?
The one which is abolished, I'm going to tell you now. This is not abolished. There is another one which is connected to dividend that is abolished.
Okay, sir.
Okay, so actually, why this dividend distribution tax is there? It is there because basically to discourage the distribution. In fact, it promote what? Reinvestment. That is why, that is the logic of this. Okay. And now Kelkar committee actually made a recommendation that dividend distribution tax should be for companies and shareholders should be, dividend distribution tax upon the shareholder should be abolished, and that got abolished later because the logic is actually what? There is a triple taxation. Okay, so here I am talking about dividend distribution of company. So dividend distribution of company is this. Then there is a dividend distribution tax upon the shareholders also. When they receive the dividend, then also it will be taxed. For example, you can see there is a tax at 30%, 3 lakh first upon the profit. Then this 5 lakh, when distributing, there is a tax upon this, the 15% upon this entire 5 lakh. Then when each individual receiving, then also there will be tax. So that is triple taxation. And that Kelkar committee was actually made a recommendation that it should be abolished from the shareholder side, and in fact that is abolished. Okay, so firstly this 10 lakh is taxed. You can see first tax, then this 15% tax, then from shareholder also it will be taxed. Now the shareholder, this is abolished, but still it is double taxation, right? Here also it is taxed and here also it is taxed. In fact, this 5 lakh is actually already taxed under this 10 lakh. It is already taxed at 30%. So it is a double taxation actually. See, in case, just 1 minute. If the charge is getting over, I have only 2% charge in my iPad and I cannot find my charger. In case if there is any problem, we will meet on next day, okay? So I'll message you in WhatsApp group. So I think we can wind up faster. So this is still a problem. What we were actually discussing, we were talking about this. So are you able to understand here? Initially there were 3 taxes. What are the 3 taxes? Firstly, your profit is 10 lakh. So flat 30% tax you are paying. And I've told you 3 lakh is paid. See, this 10 lakh include this 5 lakh also, no? So for this 5 lakh profit you already paid tax. But now when you are distributing dividend, you need to pay 15% again. Okay, and it is imposed. The logic is you can prevent distribution, to discourage distribution, so that it will be reinvested. Then upon given to the shareholder, from them also it is taxed. So triple taxation. What is abolished is the third one. Still double taxation is there here. Next, capital gains tax. CGT, capital gains tax. Okay, it is imposed on increase in value of assets. Just right? Imposed on increase in value of assets. And it is imposed at the time of sale. Imposed at the time of sale. And you see, asset means it can be physical asset, it can be financial assets, right? Physical asset means land, etc. Financial asset means shares, etc. Those things, okay? So, for example, shares. This is financial assets. So, the rate varies for this physical asset as well as for financial assets. Okay? And in the context of capital gains tax, the long-term capital gains tax is actually exempted for shares. Long-term capital gains tax is exempted. Long-term is defined as 1 year in case of financial, and in case of physical asset it is 3 year. Okay, so long-term capital gains tax is actually exempted for the financial assets or the share. That means you buy some share and keep it for 1 year, you sell that. So you bought at 100 and you sell it at 110. So what is the gain here? You get 10. Okay, so if you sell this after 1 year, this will not be taxed. But if you sell this after, let's say 6 months, then this 10 is the capital gain. That will be taxed. I hope this is clear. So if it is after 1 year, it won't be taxed. If it is short term, it will be taxed. Then ninth one, house tax. House tax or property tax. Okay, so it is actually under the state government only. Municipality tax it is. Okay, so just write there municipality. Wealth tax, when we have discussed, I have told you the house, property, etc. will not come under wealth. So wealth tax by center, it was by center and it got abolished, and instead we discussed about surcharge. So house tax by municipality, and it is under state government. So this is under state government. Wealth tax under center government. People have confusion that house tax and property tax will come under wealth. No, it will not come under wealth tax. Non-financial instruments like gold, cash, etc. 10th one, securities transaction tax. STT, securities transaction tax. Just write one line. It is imposed on buying and selling of securities in stock exchange. When you buy a share, you need to pay some tax, STT. When you sell the share, you need to pay the securities transaction tax. So it is imposed on buying and selling securities in stock exchange. And what is the rate? Rate is 0.1%. 0.1% will be the tax. That means 1 lakh rupee worth share if you are buying. What is 0.1%? 100 rupee. You need to pay. The buyer as well as the seller you need to pay, because it is imposed upon buy and sell. So when you are buying, you need to pay, and when you are selling also you need to pay. For example, you bought at 1 lakh and then you got a profit of 10,000, so you are selling at 1.1 lakh. Now when you sell, you need to pay for this, and some other buyer will be there, so he will also have to pay 0.1%. Okay, in case if you are selling at loss, let's suppose you are selling at 90,000, still you have to pay. The buyer also need to pay. So it's not connected with the profit or loss. It is connected with the transaction. Securities transaction tax. Buyer as well as seller need to pay. So when you buy, you need to pay. When you sell also you need to pay. And you don't want to get into the different charges for intraday, the daily basis, and this is normally taking delivery basis. So that is why I've told you 0.1%. Nobody will ask you what is the percentage and all. Okay. Next 11, commodities transaction tax. CTT, commodities transaction tax. It is imposed on futures trading in commodities. Okay, it is imposed on futures trading in commodities. So it is not imposed on goods and services, but on speculation of goods and services. Okay. Now 12, stamp duty imposed on purchase of property. Hope you know this. Imposed on purchase of property. Imposed on purchase of property. Buyer or seller? Only buyer, not on seller. When we discussed about securities transaction tax, I have told you both. Here only buyer. When you are buying a property, you will be paying the tax. Okay. So securities transaction tax also is a kind of stamp duty, but it is imposed on both. That's why I've told you here it is only upon the buyer. So these are
Sir, house tax is also known as property tax.
yes.
So that property and property here are different.
This is house tax. When I said when you're holding the property, you need to pay tax for the municipality monthly, yearly. You need to pay, no? When you have the property. The stamp duty means when you are buying the house, when you are purchasing. This is upon the purchase. You need to write this agreement and this. Okay, that you need to pay. So that is stamp duty. This is stamp duty. That is different. So 12 taxes, direct taxes, go through this. Can we meet tomorrow morning at 10 o'clock? Is it possible?
Yeah.
Is it possible this time? All of you? Any problem is there?
No, sir.
Okay, so only 7 students are attending, so no problem. We can meet and just 45 minutes is enough for me to explain the concept of indirect tax. Then some this tax disputes and all those cases that you can watch from the. Already I have done that. In fact, this are also done, but in the beginning I want to take. That's why I have taken. Yeah.
Excuse me, sir.
Tell me.